Let's suppose that you were offered $100 to walk across a 100-foot wooden plank laid out across the floor. Would you do it? So, I mean, you got this thing, okay? You just need to walk across. There it is. Easy money, right? $100 for nothing. I mean, you could fall off, yeah, and you that would be really embarrassing if you actually stepped off of it. But yeah, so you just step off on the floor, right? Okay, well, let's take that up now. 30 floors between two buildings. Here, this is my about as good as my art gets. Here's a couple of buildings, and now you're going to walk across, and there's the street down below with cars, people walking along. $100, right? The same wooden plank. Would you do it now? No, you would not do it, because now if you fall off, you die. Okay, the first time, you would do it when it was laying on the floor because there was no risk involved. Now there's lots of risk involved. Now, would you do it at all? Well, some of you would if, and only if, it was for a lot more money. How about for $1 million? How about $10 million? Well, maybe then you'd take lessons and practice, and then you'd do it for 10 million. Okay, some wouldn't do it for anything. I wouldn't do it at all. But that's the relationship between risk and return. Most people, normal people, okay, whatever that means, okay, most of us are risk averse. That doesn't mean we won't take risks. We just don't take risks for free. We need to be compensated for taking risk. Well, let's go in reverse here. Here's a strong lesson for you that could save you everything you have earned 20, 30 years from now. Okay. Let's suppose that I offered you $10 million to walk across a wooden plank. I lay it across the floor and say, yeah, it'll be a plank just like this. $10 million. And you say, wow, yeah, I'll do it. Okay, let's get it in writing. Let's sign a contract, and you're going to walk across it, and it's all spelled out, and you're so excited you don't read the contract carefully. But in the fine print, it clearly states that this wooden plank is going to be 30 floors up. Okay, it's going to be between two buildings. Well, you sign it and everything's illegal, and you're so excited to get your $10 million, but then they take you up 30 floors, and your face turns white, the blood drains out of it, and you didn't know. It says, wait a minute, I didn't know it was going to be so risky. But you should have known. Okay, you should have known. What's the catch? What's the catch? That should have been the first question out of your mouth. And whenever you see abnormally high returns, ultra high returns out there being peddled, those are the first words that should enter your mind. What's the catch? Because nobody pays high returns for free. Okay, they don't do it to be nice. They do it because they have to. And why do they have to? To attract investors? Because it's risky. Or a scam. Okay? Could easily be a scam. Far too many investors lose everything. It's the saddest thing in the world. It often comes out, I used to see this in Florida. Florida, you're getting, you get this stuff every now and then. You hear about this. Who do you have living in Florida? You have older people. Grew up in a different generation. Many of them where handshake was good, word was good. More trusting And you have people who are lonely, who need the company, who are trusting, and who will, you've got all kinds of, they're easy prey, is what I'm getting at. I remember there was a case when I lived there that, and this is not untypical, but this particular case, some guy and his wife, they move into town, okay, very friendly, very charismatic, man and lady. You know what? They join a local church. They get active in the church. They are super duper amazing people. They have socials over their house. And oh, and by the way, they drive a fancy car and live in a fancy house. And when the church people come on over, they see all this extravagant living. And guess what? There's a Bible in every room. And Brother Jones and Sister Jones, we'll call them, they start, teaching Sunday school, and they're right in there. And people, wow, Brother and Sister Jones, what do they do for a living? Oh, investment advisors. They're in the investment business. Wow, he must be really good. Whoa. Well, months go on. Brother Jones and Sister Jones, they are the best. Well, a deal comes across the desk of Brother Jones, the investment advisor. That's the best he's ever seen. Never seen anything like this. High returns, little risk, or no risk, because Brother Jones is so good at what he does. He's so good at it. And he's righteous. Some of these guys go way beyond. God will bless and make sure this thing, Think of all the good you can do with your money, he says to his church friends. We can fund those missions. Think of preaching the gospel everywhere. And of course, God will want to reward you with a higher standard of living for all your righteousness. I believe this is from God. Well, everybody's tripping over each other to get their money out of their retirement savings and into Brother Jones's hands. Everything they've got. I mean, what kind of smart investor doesn't want to get 25% on their money? It's only getting 8 or 9 or 5 or whatever now. Oh, how dumb is that? Let's get 20, 25. And they did. And guess what? Brother and Sister Jones skipped town, never seen again. Well, until the authorities finally caught up with them. Money was pretty much gone, spent. This sort of thing, this kind of scenario, affinity fraud, they call that. Churches, clubs, alumni associations. You see this a lot. Now, well, at least all too much. Well, they should have known, okay? It's nothing comes for free, okay? No matter how great a guy Mr. Jones or Brother Jones is. High returns mean high risk or a scam. If it's not a scam, if you know it's not a scam, know that it's high risk. And I'm not saying don't go ahead and put your money in there. I'm not saying that. I'm saying don't put more than you can afford to lose. Okay, be prudent about it. Every portfolio has room for a little bit of high-flying investments. Sure. Just understand what's involved. Okay. All right. So let's take a look at the average returns of various financial instruments. Okay. Here we have various securities, and we have their average return, and this is from 1926 to 2015. So we've got a long period of time. This is just before the Great Depression, and it includes everything since, okay? Financial crisis in the early 2000s, the whole works. This is the average returns. So let's take a look at why they're so different. Well, let's start. Small company stocks, 17.5%. Why in the world is that so much higher than large company stocks, which is average 11.9%? Well, small companies are a little riskier, right? They're young, they're unproven, they're still in the growth phase. And investors require a premium to compensate them for the additional risk. In other words, those stocks need to be priced such that the projected cash flows will result in a, roughly over this period, 17% return. Large company stocks are been around a while. They're somewhat proven. At least they're proven enough to get large. So they require less to induce people to buy them. And then we've got corporate bonds. Okay, remember those are long-term. These are long-term corporate bonds. These are debt obligations. 6.5%. So what's going on there? 6.5%. Well, going back to what's the difference between a stock and a bond? A bond is a loan. It stipulates a given interest rate and cash flow payments and dates and when this thing's going to be paid off, the maturity date. And if the company goes belly up, remember, creditors are ahead of stockholders. Stockholders are dead last. They're at the end of the bus. They get, if something's left over, that's what they get. But the bondholders stand in line before. So they're not as risky. That's why when you're the owner of a company, it's riskier when you're an owner. When you're a creditor, it's not as risky. So the return doesn't have to be as high. Corporate bonds. Why are corporate bonds, why do they pay more than treasury bonds? Now these corporate bonds, I believe, are the highest rated corporate bonds, AAA. These are companies that are in really good financial shape. And the treasury bonds are long-term debt obligations of the United States government. Well, which is more risky? You've got the same term to maturity, but one on average pays more than the other. Well, the one that on average pays more than the other is a little riskier than the other because treasury bonds have no default risk. That's the risk that they're going to go belly up and not make their payments. U.S. government's not going to go broke. The company, the AAA rated company may go broke. Sure, there's always the chance, but the AAA rated companies are in pretty good shape. So the chance is a small one that they're not going to pay this thing up. Nevertheless, it's still riskier than the treasuries. So there is a small risk premium there. And treasury bills. What's the difference? Look, quite a difference between treasury bonds and treasury bills. Treasury bills averaged 3.6%. What's the difference there? They're both issued by the United States government. So there's no default risk for either one. So what accounts for the difference between the two? Well, treasury bills are long-term. You have to wait longer to get your money to get it all back. Treasury bills are short-term. Less than a year. Usually these are 13 weeks, 3 months. Treasury bonds have some component of interest rate risk. The risk that interest rates will rise and thus send your bond price down. Treasury bills have virtually no interest rate risk. They're only 3 months typically. So, you know what? They're so short term. They have no default risk, virtually no interest rate risk. So that's our risk-free asset. You take a finance class and you're going to use Treasury bills typically as your proxy for the risk-free asset in figuring out the appropriate risk premium of a given financial asset. And inflation averages 3%. Remember we talked about real rates of return, how people aren't dumb. They're not going to invest their money at less than a positive real rate of return. Well, subtract 3 from all of these and you get an approximation of the real rate. So Treasury bills are the real rate of return on a Treasury bill would be 3.6 minus 3, so it would be 0.6%. So just barely staying ahead of inflation on average. Well, the prudent way to manage your investments is to have all of these in your portfolio. Sure, depending on how old you are and your risk tolerance is an issue as well. I mean, you could have a very prudently allocated portfolio, but if it's keeping you awake at night and you're miserable because you can't sleep, well, maybe you shouldn't have any of these small company stocks. Maybe it's financially prudent, but if your life is miserable because you can't stand it, then don't do it. But people who put all their money in Treasury bills, for example, and save for retirement, put it all there, they're not going to have much in the way of money when they retire. So you know, the trick is to spread it out. Spread it out. Just a quick and dirty, you know, a prudently allocated portfolio. This is not investment advice. Don't run off and. But typically, you want somewhere in the range of during your working years, you know, saving for retirement, maybe 60% stocks and 40% fixed income type investments, such as bonds. And as you get older and closer to retirement, that kind of trades places, where you'd have maybe 40% stocks and 60% retirement. Just to give you an idea of what a portfolio allocation might look like. Okay, it gets a little, you know, more precise than that, but that's beyond this class. Anyway, let me tell you a quick story about interest rate risk. Again, interest rate risk is the risk that interest rates will change, and the longer term your bonds, the higher as you can see, the higher the return, the longer term they are, because they do contain some interest rate risk. Well, I remember back, this actually happened to my dad, a broker. This was back in the, when was that? I don't remember. Maybe interest rates were so low. Maybe the 90s. Interest rates were extremely low. And people living on fixed incomes, retirees, weren't getting hardly any interest at all. They were counting on those interest payments, you know, and they were getting nothing. So a popular sales strategy of stockbrokers. Now I don't think there's such a thing as stockbroker anymore. I don't think you hear that term. Everybody's a financial advisor now, even though they're still stockbrokers, but nobody goes by that term that I am aware. So anyway, his brokers were calling up people and saying, hey, we've got a great investment idea for you. They were calling retirees. And remember, here's the T Treasury rates, and here's the time to maturity. This is the yield curve. And as you can see, the longer term to maturity gives you a higher rate. Short term to maturity gives you a lower rate. Why? Because the longer the maturity, the more interest rate risk you've got. So they would call up and say, hey, Well, especially they'd target people who had money in banks. They weren't even in treasury bills. They had CDs in banks, certificates of deposit. They were super risk averse. Okay, now CDs aren't any safer than treasury bills, by the way. Treasury bills are backed by the full faith and credit of the U.S. government. Certificates of deposits are, have the deposit insurance up to a certain point. So you got to, so they were essentially people who wanted no risk at all. So with interest rates falling so low, they would call up and say, hey, Mr. Jones, we've got a great idea for you. Take your money out of your CDs, out of the bank, and put them in treasury bonds. Treasury bonds. They are risk-free. They are backed by the full faith and credit of the U.S. government. And guess what? We've got a nice high rate of return for you. High return, risk-free. Take them out of these low-yielding CDs, and wow, money started flowing out of banks, and into treasuries. And that's how these brokers would get the money. And then, of course, the idea later is to move them into other higher commissioned investments. But at least they got them out and were getting commissions, for selling treasuries. Well, with interest rates so low, where are they more likely to go, up or down? Well, they really were as low as they could get. And if they're going anywhere, they're going to go up. And they did. So the strategy was buy the long-term treasury bonds. They'll say, well, I need my money before that. Well, that's okay. Sell your bonds. You're getting the high rates, and just sell bonds. Sell them in the open market when you need the money. Except when interest rates go up, what happens to the price of those bonds? They go down. And up interest rates went, and down bond prices went. And people were just wondering, all these retirees, all these fixed income people, wondering how in the world they were losing money on a government-backed, guaranteed bond. Well, it was guaranteed risk-free for default risk. It was not risk-free for interest rate risk. So if you're going to sell a bond before it matures, you're subject to interest rate risk. Again, that's the risk that interest rates will change, and bond prices and interest rates are inversely related. If interest rates go up, your bond is worth less because it's paying a lower interest rate than the current market rate. On the other hand, not all is bad. If interest rates are high and you think interest rates are going to fall, get a long-term bond, and guess what? If you have a 10% bond and interest rates, say, fall to 5%, who wants your 10% bond? Well, everybody wants your 10% bond because they can only get 5% on newly issued bonds. Well, okay, your bond price is going to go up. Your bond is worth more. So it works both ways. But I remember a broker called my dad with this sales pitch, and he said, well, what if interest rates go up? So they weren't used to being asked that. His answer, they won't. That was his answer, they won't. My dad said, are you willing to put that in writing? You willing to guarantee they won't go up? Of course not. But anyway, risk and return is a very, very important lesson. There are just too many cases where people don't know that. And they put all their money, they think they're being smart by putting it all in something like that. Or typically, well, at least the scams, are in some very fancy sounding investment. Here's another rule. If you don't understand it, don't invest in it. And believe me, some of these investments are so complicated that the salesmen don't understand it either, and they will try to kind of belittle you for not understanding it or not being sophisticated. That's a sales technique as well. Okay, well that's risk and return. Let's go on and talk about indirect finance. We talked about direct finance. Let's talk about indirect finance. This is what we had from last time. Households here send their funds, their savings, over to the business firm. They receive back a stock or a bond. The business firm takes the money and invests in a capital good. And that capital good sends back a rate of return, a return on investment. And of course, this return on investment has to be bigger than what they're paying out here for that to work. Well, let me make it clear what we mean by savings and investment, because investment in economics means invest in capital goods. When the firm invests in capital goods, that's the investing. That's where the investing takes place. When we buy a stock or a bond, we're not saving. We're not investing. We're saving. We've got to keep that straight. Now, in common language, I mean, we say I'm investing in stocks, I'm investing in bonds. Okay, that's the way we commonly say it. But in economics, we've got to keep investment and savings separate. So when you and I buy a stock or a bond, we're saving. That is saving. When the firm takes that money and buys a capital good, that is investment. That's what we're talking about. When we use the word investment in economics, we're investing in capital goods. We're investing in goods that produce other goods. This saving here, that's how they're financing the goods, the capital goods. They're financing it that way. And the financial system is how savers and investors get together. It matches one person's savings, our savings, with the firm's investments. Okay. Well, what we call that direct finance, where the savings flow directly to the firm and the stock or bond back to the household. Now, if you're a world-class company that everybody's heard of, this works just fine. But what if you're Bob's Lawn and Bike Repair? Okay, lawn mowing and bike repair, and you need some money to buy a lawnmower and bike repair equipment, something like that. Are you going to be able to issue stocks and bonds to the public? Well, no, not really, because no one's heard of you. You can take out all the ads you want and say you've got stock. You're selling stock in your company, and it's not going to happen. No one's heard of you, and so what you need to do is go to a financial intermediary. And this is actually how most financing takes place. So we're going to put something in between here. There's a financial institution of some kind, a bank, savings and loan, so on. I'll just say bank for short. So what happens here? You send your savings over to the bank, okay, and the bank gives you a bank account, right? And then the bank can lend the money, okay, let's just call this funds. They sending the money, the funds over, and the bank has it. They pay you interest here. They lend it out for a higher rate of interest, and the bank gets back, they sign a loan agreement. And then all this is the same. Nothing changes here. So what changes is this: we've got this financial institution in there now. This is what really makes it possible for anyone to really buy a house You know, you go to the bank, you get money to buy a house, right? So we put our money in the bank. The bank has this pool of money. They send it out to a business firm to buy capital investment, or for you and I to get a mortgage and buy a house. And we pay interest on that loan, and that's how it works. If you're going to go out and advertise to buy a house, you know, put an ad out there. Hey, I'm seeking money to buy a house. I'm willing to pay 8% interest. You're going to get nothing. But the bank, see, they're pretty good at that. The bank is pretty good at analyzing financial risk and to see if you're capable of repaying the loan. And they've got people trained in that. So if you go to the bank and you don't have a job and you don't have any income and you don't have any savings, you don't have any collateral, see, they're not going to risk the depositor's funds on you, okay? So they're going to carefully scrutinize you and determine whether you should get a loan or not. Same with a business firm. You go in and you've got a business you want to start up, or you're an existing business and you need new equipment. Let's say you've got a little cafe somewhere and you need a new stove. And it's kind of expensive, so you want to finance. You go to the bank and you lay out give them your financial statements and say, well, this is how much money we bring in each year, and they'll analyze that and they'll say, okay, well, we'll lend you the money. You buy your stove. You're going to pay so much to us, you're going to estimate that this stove is going to return so much to you. In this case, it allows you to stay open. And you're going to pay the loan, the interest and the loan back to the bank. That is indirect finance, meaning these funds don't go directly to the firm. There's an intermediary. Okay. Well, there's one more financial institution we need to make mention of before we call it quits here. And that is a very, very important and very popular financial institution. Let's erase this. Called a mutual fund. You know, these are pretty, it used to be, okay, back before these got really popular, I guess, in the 1970s. But it used to be that only people who had a lot of wealth could invest in stocks and bonds. Remember all those returns? Remember these high returns here? These high returns were only available to wealthy people, really, because they are the only ones who had enough money to buy these things and to have an appropriately diversified portfolio. You know, you need to really be properly diversified, 100,000 or so, a couple hundred, to really spread this out in a cost-effective ways where you could buy around lots of stock. That used to be an issue more than it is now. Nowadays, you've got Charles Schwab selling fractional shares, no commissions. So the competition among financial institutions, brokerage firms, has really changed things quite a bit. But that's been fairly recent. But mutual funds came on the scene, and what you do when you buy a mutual fund is you'll buy shares in a mutual fund. You'll send your money over to the mutual fund, and the mutual fund will sell you stock in the fund. So you buy actual shares in the fund. You'll own stock in the mutual fund. The mutual fund is just a company. It's a company. It's called an investment company. What they do is they buy stock in other firms. They don't produce any goods. They just buy stocks and bonds in other companies. So these are people, you've got portfolio managers, financial analysts, who are employed by the mutual fund, so they You send your money over to the mutual fund. They sell you stock in the fund, in the company, and then they use their expertise to go out and buy stocks and bonds in what they think are the best companies. So, for a very small amount of money, you can buy stock in a mutual fund and have a well-diversified portfolio, highly diversified. So they have just, there are now more mutual funds than there are actual stocks trading on the exchanges. There's a zillion of them. And you can get pretty cheap ones. There are no-load funds that don't pay any, charge any commissions, and you've got to watch the management fees and all that stuff. But you can get mutual funds for pretty cheap these days, and really, there's no better way to invest in the financial markets than through a mutual fund. So that you get further into that in an investments class or a personal finance class, but there's just enough to make you pretty darn dangerous, I should say. So be careful. we just skipped over the top here, just the very surface. All right, that's it for introduction to the financial system and some of the features and characteristics. Next, we're going to do a little more of a technical part of this, where we're going to use some equations and graphs, and things are going to get a little bit harder in the next section. So we'll see you then.